Goodness gracious, that's like a fraction, that's 15 basis points. It's very little in the grand scheme of things.
The DST is just too expensive with the ongoing fees, David, or I guess maybe it could even be for wealth managers like yourself, right? Your fees, they're so expensive. And so I'll give an example. Someone's selling we just did a deal in like the Santa Cruz area. It was a $7.9 million sale, and they had about $2.6 million of liability of tax. So they paid off debt, by the way, of about $2 million, and they put about $6 million or so into the trust and deferred the 2.6. And they go, how can you charge, this? And that deal, I think it's somewhere around 1.3 or 1.4% on an annual basis, recurring, and the setup fees about 1.5% of the sales price. You have a little bit of a break over $1 million. But that being said, just give us from the fee of the forest or the tree versus the forest, right? And how would you if someone's in the shoes right now thinking it's too expensive, what would be your response to that?
I think here's what I would do is I would take a step back and think about the expenses related. I would do three things. I would do what we call basically a holding period return analysis. So one investment says, if I understood you properly, you make the transaction, you defer 2.6 million in taxes, you're left with 6 million, right? And then I would say, well, what are 2.6 million in taxes deferred as a function of the initial sale amount, right? That percent, divide by 10. Assume a 10-year holding period. We can all do that math, right? Do that right now. And so that's going to be a number. And I would compare that number to the original initial setup fees, right? I think you mentioned, maybe is it 1.5% setup, right? Okay, divide that by 10. Because even though you pay it up front, the reality is it's buying you this 10-year long transaction. Divide that by 10. Goodness gracious, that's like a fraction, that's 15 basis points. It's very little in the grand scheme of things. And then I would add that to your annual running costs to manage the money and have the trustee oversight and all that. I think when you compare those, I think you will find out that the break-even rate, right? The amount of time it takes you with some reasonable rate of return, whereby the upfront fees to set up the trust plus the running fees over that break-even period of time compared as a percent to the taxes you saved spread out over time, your break-evens look like a couple of years, not even. I mean, and then after that, you could argue, right? I'm not saying it's free, but you could argue all the time after that break-even where expenses cross tax savings, that's free. The trust and the transaction is in effect free to you, the investor. And so that's the way I would look at it. I don't think you can say, I would have to write a check for this for legal and a check for that for accounting and then pay ongoing management fees and trustee fees. You have to pick a period, make it 5 years. 10 years is the normal trust period, and just do that very simple back of the envelope math. It doesn't have to be rocket scientist. Don't worry about compounding of interest and all that. Just do simple straight line arithmetic. And I think you'll find that break even is really very early on in this transaction type, and the rest is you could argue gravy.
Beautiful. Let me see if I can encapsulate that. And that was just so articulate and so well said. And I love the way you broke that down. So you take the liability, let's say 2.6 million, and you divide that by the price, right? The 7.9 million, or the asset sales price. Or even in this scenario too, I would also maybe wonder if you do it by the net proceeds, because they're going to pay off about $2 million of debt, so let's just put it at 6, and you divide that by 10, that gives you a number. And then you're going to take the 1.5%, let's say that's the number, and you divide that by 10, and you go, okay, that's about 15 basis points. Let's assume a 10-year period of time. And then we're going to do the plus the annual running cost. And at a certain point, you're gonna compare and contrast those two versus just paying the tax, and you're gonna get a break-even rate where essentially you say, okay, this 2.6 that I would have paid, I'm earning interest on this net of the recurring running cost fees, and it breaks even at 2 or 3 years, and then after that, it's all free or it's no longer costing me, right? My return on my investment on this, if you will, is now infinite returns. Is that a fair summary?
Yeah, fair summary. A couple of things, caveats. So, whether or not you do the 2.6 in tax savings on the original sale amount or the base, that could be debated. You could do it both ways. It wouldn't take long. It's just a pencil and a calculator or Excel. You would want to assume some rate of return for the monies that you didn't pay on taxes, but in fact invested. Right. Here's the very simple point. Just in a simple snapshot, assume you have an extra 2.6 million. Cut right to the heart of the matter. You would have had the other money anyway, so assume marginal only. Assume you have 2.6 million more than you would have because you didn't spend that on taxes. Now, 2.6 million, taking into account, call it 1.5% per year. That's on 2.6 million. You're talking. Yeah, I came to the math in my head, unfortunately, very quickly, but you could assume that 2.6 million earns, something very conservative, 5% a year. I think we could all figure out that, 5% on the 2.6 million savings is clearly more than what all these other, what the other startup and running fees are on the total amount. Right. That's kind of the break-even analysis.
Excellent. Very well said. And for those who want a full analysis, you can go to capitalgainstaxsolutions.com and we can customize that for you. By the way, we don't charge anything for anything unless and if you close the deal. And this the deal actually closes. So it's no cost, no obligation, due diligence period.